Alright folks, listen up. Today, we're diving into a real estate showdown. In one corner we've got Realty Income, the heavyweight champ of monthly dividend stocks. In the other corner, AGNC Investment Corp, the scrappy contender in the mortgage REIT space. Both of these bad boys are fighting for your investment dollars. Realty Income, known as the monthly dividend company, focuses on freestanding, single-tenant commercial properties. Think Walgreens, Dollar Generals, FedEx distribution centers. AGNC Investment Corp deals with residential mortgage-backed securities, primarily those guaranteed by U.S. government agencies. They're not traditional landlords but make money by investing in bundles of home loans. It's a different ballgame, but one that can be just as lucrative. Let's take a trip down memory lane. Realty Income started from humble beginnings in 1969. Founded by William and Joan Clark in Escondido, California, the company began with a simple idea: buy properties, lease them to strong tenants, and collect steady rent. In 1994, they went public. Listing on the New York Stock Exchange under the ticker symbol O. Realty Income started paying monthly dividends in 1970. They've been doing it ever since, with over 600 consecutive monthly dividend payments. In 2021, they merged with Verit in an $11 billion deal. This merger expanded their portfolio to over 11,000 properties. Realty Income's journey from a small company to a REIT powerhouse is truly remarkable. Now let's talk about the new kid on the block, AGNC Investment Corp. Born in the midst of the 2008 financial crisis, AGNC saw an opportunity where others saw disaster. Founded by American Capital Limited, AGNC focuses on residential mortgage-backed securities guaranteed by U.S. government agencies like Fannie Mae and Freddie Mac. This government backing provides a level of security. AGNC went public in 2008 and has been paying monthly dividends since day one. They quickly grew to become one of the largest mortgage REITs in the market. AGNC's business model is different but effective. They invest in government-backed securities, providing a safety net. Not bad for a company that's younger than the iPhone. Let's talk about why Realty Income is known as the monthly dividend company. Realty Income has been paying monthly dividends for over 50 years. They've increased their dividend 115 times since going public in 1994. Realty Income focuses on single-tenant net lease properties, meaning tenants handle most property expenses. Their top tenants include Walgreens, 7-Eleven, and Dollar General. Realty Income's portfolio is diversified across 49 states and Puerto Rico, including retail, industrial, office, and agricultural properties. They've also expanded internationally with properties in the UK and Spain. This international expansion opens up new growth opportunities. Realty Income has delivered positive total returns to its shareholders in 25 out of 27 years since going public. Their business model is solid, focusing on high-quality tenants and properties. Realty Income's consistency and reliability make it a strong investment. It's like having a buffet of real estate investments all wrapped up in one stock. Investors can sleep well at night knowing their money is in good hands. Now let's talk about some potential downsides of Realty Income. REITs like Realty Income are sensitive to interest rate changes. When rates go up, REIT stock prices tend to go down. Realty Income is a big company, and with size comes slower growth. They need to make larger acquisitions to move the needle. A significant portion of Realty Income's portfolio is in retail properties. The retail landscape is changing rapidly, and there's always the risk that changing consumer habits could impact their tenants' businesses. Realty Income often trades at a premium compared to other REITs. This higher valuation means there's less room for capital appreciation. If you're buying Realty Income, you're probably doing it for the dividend income. While those monthly dividends are nice, they're not guaranteed. If the company hits a rough patch, those dividend increases might slow down, or the dividend could be cut. It's always a possibility in the world of investing. Now let's talk about why AGNC Investment Corp attracts investors. AGNC has consistently offered some of the highest dividend yields in the REIT sector. We're talking double-digit yields here, folks. Like Realty Income, AGNC pays its dividends monthly. This monthly payout schedule can be particularly attractive for retirees or anyone looking to supplement their regular income. AGNC focuses on agency mortgage-backed securities, which are bundles of home loans guaranteed by U.S. government agencies. This government backing provides a level of security. AGNC uses leverage to amplify its returns. They borrow money at low short-term rates and invest it in higher-yielding mortgage-backed securities. When the spread between short-term and long-term rates is wide, AGNC can generate impressive returns. AGNC's business model is different, but effective. It's like using the bank's money to make more money. Let's talk about the risks associated with AGNC Investment Corp. AGNC's business model is highly sensitive to interest rate changes. Rising short-term rates squeeze their profit margins. AGNC also faces prepayment risk. Falling rates lead to mortgage refinancing. High-yield mortgages get paid off early, forcing reinvestment at lower rates. Leverage boosts returns but also magnifies losses. Market disruptions can plummet AGNC's book value. AGNC has cut its dividends several times. For income investors, a dividend cut is a serious blow. AGNC's complex model makes risk assessment challenging. Section 8. Key takeaways: Realty Income versus AGNC Investment Corp. Alright folks, let's bring it all together. We've been on quite a journey comparing these two real estate investment powerhouses. On one side, we've got Realty Income, the steady Eddie of the REIT world. On the other, we've got AGNC Investment Corp, the high-yield maverick of mortgage REITs. Both have their strengths and both have their weaknesses. It's like comparing apples and oranges. They're both fruit, but they're fundamentally different. Let's start with Realty Income. What we've got here is a company with a long track record of consistent performance. We're talking about over 50 years of monthly dividends, 115 dividend increases since going public, and a diverse portfolio of high-quality, recession-resistant tenants. It's like the tortoise in the race, slow and steady, but it keeps on going. The downside? Well, that stability comes at a price. Realty Income often trades at a premium compared to other REITs.